Hello, everyone. Hello. I believe all of you are doing good. And so I am here with the discussion of the top 25, the super 25 topics of ACCA FR and SBR. So for this, what I have done is I have analyzed. Okay. Now before that, I believe my audio and video is clear to all of you. Okay. I believe my audio and video is clear to all of you. Okay. Now, without wasting even a single minute of our time, so let us quickly jump to the discussion. Okay, let us quickly jump to the discussion. So now what I have done is I have analyzed the past papers, the practice papers, the specimen papers, okay, of FR and SBR. Okay, now what I found is there are few small topics, okay, which we generally tend to forget. So I have taken up those topics which generally gets repeated in the exam, or which we might miss, or which is critical for the exams, okay, or which is complex for you to understand. So I've taken up all those topics, made a list of around 25 topics, but not 25 exactly. I can say there is something more also. I have taken up 27 topics. Okay, I have taken up 27 topics, and I'll be discussing these 27 topics with you guys. Okay, now, so let us discuss into the depth of it. Okay. Now I'll be discussing the concept. Additionally, I'll take up the examples also wherever needed. Okay. Now watch this video till the end. Be in the session till the end. I can definitely assure you that this is definitely going to increase your marks in the upcoming exams. Okay. So now tell me, shall we start? Come on, guys. Come on. Come on. Tell me, shall we start? Shall we start? Shall we start? Come on, guys. Please tell me. Come on. How's the Josh? I can't see the Josh in the students. Come on, guys. Show me the Josh. Come on, guys. Come on, come on, come on. And you are watching the session and not liking it. Very bad. Come on, guys. All of you, please like the session as well. All of you, come on, please like the session. Please like the session, and yes, if you have not subscribed to the channel, do that as well. Okay, now without wasting even a single minute of time, let us start the discussion of all the topics. Okay, but yes, do ensure that you are liking the session. Okay, chalo, come on, guys, let us start the session now. Okay, chalo. So we are discussing these topics, okay, and I believe I have already released the list. I have already released the list before the discussion itself, and today I'll be focusing only on the discussion of these topics. Come on, let us start the discussion now. Just a minute. Yes. Chalo. First topic comes as compound financial instrument. Okay. Now, what is the meaning of compound financial instrument? What is the meaning of compound financial instrument? Compound financial instrument means an instrument which has the features of equity and financial liability both. An instrument which has the features of equity and financial liability both is called as a compound financial instrument. Now, since this instrument has the feature of equity and financial liability both, we are required to segregate the instrument into equity and financial liability. Now, equity will be accounted as per equity accounting, and financial liability will be accounted as per amortized cost method accounting. So that's the reason on the date of the issue of the instrument itself, we have to split the instrument into two parts, and that's why we name it as split accounting, and this split has to be done on the date of issue of the instrument. Okay, now comes the question, how do we need to split the instrument? How do we need to split the instrument? To do the split accounting, we need to first of all break the instrument into small parts: principal, interest or dividend, and the conversion rights. I'm writing it here. See here: principal, interest or dividend, and conversion rights. Now understand, conversion right ideally is always equity. Conversion right ideally is always equity. Now interest or dividend, if it is mandatory payable, it has to be paid mandatorily, then it is financial liability. Okay, just understand guys one thing. Just because it is written dividend, don't assume it to be equity. Just because it is written interest, don't assume it to be a financial liability element. No. Okay, always think from the substance of the contract. Now, what is the substance? Tell me, what is the meaning of a financial liability? It is unavoidable. Okay, if an interest payment is unavoidable, it is financial liability. If an interest payment is avoidable, then also it becomes equity. Then it becomes equity. Even though the name is interest, it can be an equity. It can be equity. Okay. Now, if dividend is unavoidable, even though the name is dividend, it can be a financial liability. So we have to focus on the substance of the contract rather than the form of the contract. Okay. We are not required to focus on the legal form. We are required to focus on the substance of the contract. Now, principal, if it is redeemable, it is financial liability. If it is convertible, then we have to see if it is optionally convertible. If it is optionally convertible at the option of the instrument holder, then it becomes financial liability. Okay. If it is compulsorily convertible to fixed number of equity shares, equity, to variable number of equity shares, financial liability. If the question is silent whether it is compulsorily convertible or optionally convertible, then we assume it to be financial liability. Now, to summarize it, I can say conversion right is always equity. Interest or dividend, if it is mandatory to be paid, if it is unavoidable, then it is a financial liability. If it is avoidable, it's an equity. Okay. Now, principal, if it is compulsorily convertible to fixed number of equity shares, if it is compulsorily convertible to fixed number of equity shares, then it is equity. Rest in all cases, it is financial liability. Okay. So now we have identified which element of this instrument is equity and which element of this instrument is financial liability. Now we need to find out the value of equity and financial liability. How to do that? So we calculate the present value of contractual cash flows. We calculate the present value of contractual cash flows, that is the FL element, using the market rate of instrument without conversion right, because it's a conversion right that makes this instrument a compound financial instrument. Okay. So now we are eliminating the conversion right and see what is the value of the pure financial liability element. Now, whatever remains is your equity. Whatever remains is your equity. Now, this is something called as a theoretical discussion, but shall we restrict ourselves to that only? No. Let us focus on something called as numbers also. Okay, let us focus on numbers also. So I'll take up an example and discuss that as well, so that you get a conceptual clarity on the same. Now, understand what it writes. Convert company issues convertible debentures of $5 million that pays interest at the rate of 2% per annum in arrears. The loan of $5 million is repayable in full. After 3 years, or convertible to 1,000 equity shares of convert company. Now, what happens here? It is either repayable or convertible, means it becomes optionally convertible. So understand, principal is optionally convertible, hence it is financial liability. Now, this interest of 2% has to be paid in arrears, means it has to be paid monetarily, right? So interest is also financial liability, and conversion right will always be equity. So now understand, principal and interest is financial liability and conversion right is equity. So now how to find out the value of financial liability? So let us compute the present value of principal, present value of interest. At what rate? Market rate of similar instrument without any conversion right. So what is the market rate of similar instrument? The market rate is 8% without the interest rate for the debt without the conversion right, that is 8%. So we have to calculate the present value at the rate of 8%. Now tell me, principal has to be paid when? At the end of third year, that is a tenure. What is the principal? 5 million. So I'm taking the amount in thousands. So 5 million in thousands is 5,000 multiplied by discount factor 8% at the end of third year is 0.794. Okay, so this is the present value. Now interest is how much? 5,000 multiplied by interest rate is 2%. So this is the interest that has to be paid every year for 3 years. So now tell me, will I take present value factor here or annuity factor? I'll be taking here annuity factor. Now what is the annuity factor? The aggregate of all three. Can you please add up? So it's 0.926 plus 0.857 plus 0.794, it becomes 2.577. 2.577. So now what is the present value? Can you please tell me? 5000 into 0.794, this becomes 3970. Now 5000 into 0.02 into 2.577, that becomes 257.70. If you add up 3970 plus 257.7, it becomes 4227.70, and this is the value of financial liability. This is the value of financial liability. Okay, now what is the value of the entire instrument? It is 5000. So what is the residual amount? What is the residual amount? The residual value is called as equity. Okay, so now it is 5000 minus 4227.7, it is equals to 5000 minus 4227.7, it is 772.30. So now what will happen? What will happen is, on the date of the issue of the instrument, company has received in the bank account how much? 5000. Company has received how much? 5000. Now, 2 financial liability is 4227.70. 2 equity element is 772.30. This is the equity element. So this is how we are going to segregate or split the instrument into equity and financial liability. Tell me, are you understanding this part? Are you understanding the split? Okay, now Sahil is asking, sir, if the principal was not financial liability, we would not have taken the repayment in the present value calculation. Yes, Sahil. Okay, so now understand, Sahil, to answer your point, if this 5 million would have been compulsorily convertible to equity shares, if it was compulsorily convertible to equity shares, then in that case it would have become not equity component, not an financial liability component. So in that case we would have not taken the present value of the 5 million thing. Okay, now what happens? This instrument is, the instrument is there for 3 years. So now what we will do is, for the 3 years we'll do the accounting. Now equity will remain constant. Equity will remain constant. Equity will remain constant at 772.30. But financial liability will keep on unwinding at the same rate which we used to compute the present value. So now tell me, what is the unwinding? So we calculated the present value at the rate of 8%. So we'll unwind also at the rate of 8%. We'll unwind also at the rate of 8%. Just a minute. So finance cost here will be 427.7 into 0.08 is 338.22. Okay, now here you have to pay how much? 5000 into 0.02 is 100, you will pay here. Okay, then again you will charge finance cost, again you will pay 100, again you will charge finance cost, again you will pay 100. Okay, and the balance of the financial liability here will be, the balance of the financial liability will be here 5000. If you do the unwinding and calculate, this is what is the value which you are going to get. Okay, so opening, this is the opening balance. This is the opening balance plus finance cost minus payment. Again, this balance will, on this balance will compute finance cost at the rate of 8%, then pay off 100, and then this is the balance of the second year. Now on this balance, I will compute the finance cost at the rate of 8%, pay off 100, will get the value of 5000. We'll get the value of 5000. Okay. Now on the settlement date, we have these data. On the settlement date, we have 5,772.3 as equity and financial liability. So now how are we going to do the accounting on the settlement date? So understand, since it was optionally convertible, now we have to see whether the instrument holders are asking for cash or equity. If they're asking for cash, then what we will do? Financial liability account debit to bank 5000, to bank 5000, and this equity will be transferred to other components of equity or retained earnings. Okay, now if the instrument holders are asking for equity, Then what we will do? Let's suppose here I'll add a page. I'll add a page and I'll write here on this date. If the instrument holders asks for cash, or if the instrument holder asks for equity shares, then how are we going to do the accounting? So if they ask for cash, we'll simply say FL account debit 5,000 to bank 5,000 plus what will happen to equity? Equity will be transferred to retained earnings 772.3. Okay. Now, second, if the instrument holders asks for equity shares, then first of all, I will transfer FL account debit 5,000 because we are not required to pay cash to equity. I will transfer it to first of all equity 5,000. Now, what is the balance of equity now? Earlier I had 772, now I transferred 5,000. So my equity balance becomes 5772.30. From this, I will issue equity share capital at face value. Okay. And whatever is the excess amount will be transferred to securities premium. What will be transferred to securities premium? Any excess amount will be transferred to securities premium. Cassis has a query. If it was advance payment with the convertible share and having commencement date amount also, so what do we need to do? We have paid the advance amount. Okay. So understand, your query is not holding good here, Cassis, because see, understand, in this convertible instruments, the whole amount is received by the entity on the date of the issue of the instrument. Right, on the date of the issue of the instrument itself, we have paid the whole amount. Right, the instrument holders have paid me the whole amount. Right, now it is the entity who is doing the segregation of FL and equity, who is doing the segregation of FL and equity. Okay, and doing the, for FL part, FL accounting, for equity part, equity accounting. On the settlement date, the entity asks the instrument holders, what do you want? You want cash? I will give you cash. You want equity shares? I will give you equity shares, because it was optionally convertible. It was optionally convertible. Now, had this been a question of compulsorily convertible to fixed number of equity shares, now tell me, will we give this option to the instrument holders? No. No. So in that case, we'll simply debit equity to equity share capital to securities premium. I believe that is very much clear to all of you now. That's what I have written here in the notes also. So on the date of issue of the instrument, the whole responsibility is to segregate. Subsequently, for equity part, we keep it at its value. For FL, we apply ACM accounting. On settlement date, for equity, if it has to be settled in equity, we give equity shares. The difference is to be transferred to securities premium. If it has to be settled in the form of cash, we give cash, and the equity portion is transferred to retained earnings. Okay, so this is what I have done. So I've explained the calculations, the logic, and the question also. Okay, I believe this concept is clear to all of you. Now coming to the second concept. Of principal and agent. Guys, understand please. These aggregators, particularly if you talk about in India, make my trip, book my show, right? All these things, they are aggregator. So what they do, they are a marketplace which lists the product of multiple entities. Like for example, Amazon. Tell me, is Amazon the seller? No. Amazon has just listed the products of multiple entities. So Amazon is an agent, not the principal. Okay, Amazon is just an agent, not the principal. Principal are the sellers of the product, not the Amazon. I believe you are understanding this part. So now when you pay Amazon an amount of, let's suppose rupees $1,000, when you pay an amount of $1,000 to Amazon, tell me, is it will Amazon record the entire amount of $1,000 as revenue? No. No. So Amazon has to recognize a revenue only for the commission income of Amazon. Amazon has to recognize a revenue only for the commission income of Amazon. The rest amount has to be recognized as revenue by the principal who actually sold the product. So understand, the whole understanding of this discussion here is principal should recognize the gross revenue, but agent should recognize only commission income as revenue. Only commission income as revenue. Okay, this is the whole discussion. But now the understanding or the challenge that comes up in the exam is how to identify who is the principal and who is the agent. So the standard IFRS 15 have given you a few indicators, to identify who is principal and who is agent. So understand, there are three indicators given in the standard. Now understand, in the exam we are not required to see whether all the 3 points are getting satisfied or not. No, we have to apply our logic. We just need to apply our logic, a thought process, because they are indicators, they are not conditions. Had these been three conditions, then I would have said, okay, all the three conditions has to be satisfied. No. So neither I'm saying all the three has to be satisfied, nor I'm saying any one has to be satisfied. No. Standard has given you indicator, and now you have to apply your judgment and understand which one is principal and which one is agent. Now, what is the understanding and what is the main rationale? I'll explain both. Just listen to me carefully. The indicators given in the standard is who bears the primary responsibility of fulfilling the contract. Now, who bears the inventory risk? Who has the right to establish the price? Okay, who has the right to establish the price? The person who has the right to establish the price is the principal. The person who bears the inventory risk is the principal. The person who has the primary responsibility of fulfilling the contract is the principal. I believe you are understanding. Let me give you an example. Let's suppose I booked my flight tickets using an agent. Okay, so now tell me, agent agent had some quota to sell the tickets, flight tickets. Agent was not able to sell the flight tickets. Okay, the flight was vacant. Tell me, who is bearing the risk? Is it the airline or the agent? It's the airline that bears the risk, the inventory risk. Okay, for airline, the seats are the inventory, right? If the seat is vacant, it's an inventory loss. It's a loss. Okay, so now comes the understanding is what exactly or how exactly in the exam we will see. Very well pointed, Amir Osman, very well pointed. So the key point here is understand, if the control of the goods, if the control of the inventory transfers from the principal to the customer directly, then the middle person is the agent. Now, but if the control of the inventory transfers from the airline to the agent and agent sells it to the customer, then this agent also becomes principal. Understand? I'll explain this with the help of an example. Let's suppose I will explain this with the help of example. This is an airline. Let's suppose Air India. This is an agent. Make My Trip is an agent, and this is a customer. Okay, now understand, Air India gave Make My Trip that, okay, I am giving you 100 tickets. You please sell these 100 tickets. Okay, you please sell these 100 tickets. Now, Make My Trip sells 60 tickets. Make My Trip sells 60 tickets. Tell me, who bears the inventory risk? And since Make My Trip is unable to sell 40 tickets, it is returned to Air India. 40 tickets are returned back to Air India. Tell me who bears the inventory risk in this case? Air India. Air India bears the inventory risk. So who is the principal? Who is the principal? Air India is the principal, wherein MMT is selling the tickets on behalf of Air India. Hence, Air India is the principal, Make My Trip is the agent. Now, let us change the situation. Let us change the situation. MMT purchased 100 tickets from Air India. MMT purchased MMT purchased 100 tickets from Air India. Now MMT was able to sell only 60 tickets. Now tell me who will bear the loss of 40 tickets? Who will bear the loss of 40 tickets? It's Make My Trip who bears the risk. It's Make My Trip who bears the risk. So here in this case, Make My Trip becomes the principal. Okay, Make My Trip becomes the principal, and here this is the principal and this is an agent. Okay, now I believe this is clear to all of you. Coming to the third topic, revenue recognition. Guys, the topics which I'm discussing are equally applicable for FR, for SBR, both. Okay, so these will be applicable for both of you. So please listen to me carefully and watch the session till the end. And yes, if you have not liked the video so far, please do that right now. Topic number 3 is revenue recognition. Guys, I believe you understand a concept. I believe you understand a concept that revenue, when we recognize revenue as per IFRS 15, the control can be transferred over a period of time or at a point of time. Like for example, okay, you taking my FR classes, okay, then the service that is given to you, the control is being transferred over the period of time. Let's suppose 3 months over which our classes continues. But let's suppose you purchase my FR capsule book. So you give the money, you get the book. It is the control gets transferred at a specific point of time. The control gets transferred at a specific point of time. Okay, so then we say revenue has to be recognized at a specific point of time. Now understand please. When the revenue has to be recognized over a period of time, now comes the question, how much revenue has to be recognized at what particular date? How much revenue has to be recognized at what particular date? Now, okay, before going to the third concept, Adib is asking what type of question can be asked for principal and agent. I have seen 3 to 4 questions, but primarily if I say Adib, there are 2 type of questions that can be asked. Okay, one in section A and section B and another in section C. Okay, I'll take up one question of section A and section B. If you want me to, I'll take it up. Just allow me a moment. See here, I'll just discuss that with you. Which of these has correctly recognized revenue? Agency sales of 250,000 on which Repro is entitled to a commission. Since it was an agency sales, can we recognize the whole amount as revenue? No, we should be ideally recognizing only the commission income, right? But the company has recognized the whole amount as revenue, which is wrong. This is one type of question that can be asked. Okay, now I'm moving on to my third topic for revenue recognition. Now, when the revenue has to be recognized at a specific point of time, guys, understand, whenever you see a question, this is a very common mistake which I see students making in the question. Very important, and I can assure you, I can guarantee you, a revenue is a topic from which definitely you will see a question in the exam. I can give you a guarantee that definitely in the exam, see, there are few topics which will definitely be tested in the exam. Like for example, revenue, like for example, group accounting. These are evergreen topics. Examiner will ask, like for example, leases. Examiner will definitely ask. Like for example, financial instruments. Examiner will definitely ask these topics. Compound financial instrument. Examiner will definitely ask this topic. Okay, as per in my experience, what I have seen, compound financial instrument they will ask only. Okay, in SBR they might ask, they might not ask. Okay, but sometimes they do ask in SBR also. In SBR also they do ask. Now understand, revenue recognition. So understand, whenever you see that the control is getting transferred over a period of time, whenever you see control is getting transferred over a period of time, don't check anything else. Don't check anything else. Just check, first of all, check whether the contract is a profitable contract or a loss making contract, or it is uncertain, Okay, now how will you evaluate if it is a profitable contract or a loss making contract or an uncertain? Check what is the total contract price, what is the total contract price, and what is the estimated cost. What is the estimated cost? Okay, now understand, let's suppose the contract price is 100 and the estimated cost, total cost is let's suppose 80. So 100 minus 80, 20 is a profit, so it is a profitable contract. Let's suppose total contract price is 100 but the estimated cost is 112. So now 100 minus 112, 12 is the loss, so it's a loss making contract. It's a loss making contract. But now let's suppose, so far if we have completed only 5% or 6% of the project, meaning thereby we are at the very initial stage of the project, and determining whether it is a profitable or a loss making is not possible as of now, so in that case we say it is uncertain. We don't know whether it is a profitable contract or will it be a loss making contract. We don't know that. Now comes the question, how will we recognize revenue? How will we recognize revenue? Now, FR students, you should expect a question from this either in your section A or section B or section C. SBR students, you can expect a question from particularly this one. You can expect a question particularly from this one in your section A, question number 2 on ethics. Okay, question number 2 on ethics, you can see a question, or question number 3, you can see a question from this one. Okay, now understand, if the contract is a profitable contract, what we do? We recognize revenue and cost of sales as per input method or output method. Now you will ask me, sir, how to compute revenue and cost of sales as per input method or output method? Don't you worry, I am there to help you out. Now understand, under input method, we calculate the percentage of completion by cost incurred till date divided by cost incurred plus further estimated cost, that is total cost. Let's suppose the contract is a 3-year contract. The contract is a 3-year contract. At the end of first year, we have already incurred $25 million. But we are yet to perform for year 2 and year 3. So for the future years, we will definitely have an estimate of the total cost that will be incurred, right? So cost incurred till date plus the cost that will be incurred in year 2 and year 3, that becomes total cost. So which will give us the percentage of completion of the project. So when you know the percentage of completion, what is the amount of revenue? The revenue will be contract price multiplied by percentage of completion minus revenue already recognized in the earlier years. What is cost of sales? The cost incurred in the current year will be the cost of sales. So this is how you recognize revenue as per input method. Tell me, is it clear, everyone? Is input method clear to everyone? Okay, now coming to output method. Now percentage completion will be work certified till date divided by the total contract price. Guys, you might be wondering, sir, in exam, how will we identify whether it will be input method or output method? Now see, Srushti asked also how to identify in the exam. So for that, you need to understand Ideally question will specify. If the question doesn't specify, question will give you a hint. Okay, question will give you a hint. Question will say cost to cost method. When the question says cost to cost method, question means input method. Okay, when the question says value of work completed, question will say measure of progress has to be done on the basis of value of work completed, value of work completed, or value of work certified. Then the question means to say output method. Okay, still if the question is not liking writing this line also, question is not giving any statement, question is not giving any hint, then in that case we use input method as the default one. Okay, we will do input method as the default one. Now, under output method, how do we need to recognize revenue and cost of sales? Again, very simple, very simple. Understand? Cumulative work certified minus revenue already recognized. Okay, is the amount of revenue that we have to recognize in the current year. Can I give you a hint? Under work certified method, the work certified in the current year is the revenue for the current year. Under output method, work certified in the current year is the revenue for the current year. Okay, now understand what is the cost of sales. Cost incurred in the current year is your cost of sales. Cost incurred in the current year will be the cost of sales. I believe input method and output method is clear to all of you. I believe input method and output method is clear to all of you. Okay. Now you must, sir, where can we get these notes? Need not worry, my dear friends. These notes you can get in my Telegram group. These notes you can get in my Telegram group, and the link of Telegram group is already pinned in the chat box. You can join from their Telegram group. So today after the class, I will be sharing all these notes in my Telegram group. So please do join the Telegram group and get the access to these notes. Okay. Now, so I believe you are clear if the contract is profitable. Now, contract is loss making, I will discuss separately. What if it is uncertain whether the contract will be a profit making or a contract will be a loss making? Then what to do? Then in this case, if it is uncertain, standard asks us, in that case, standard asks us, need not recognize any revenue, need not recognize any profit, meaning thereby whatever is the cost incurred is your cost of sales, is your revenue. Whatever is the cost incurred in the current year, is your cost of sales, is your revenue. Let's suppose you incurred a cost of $250 million in the current year. So you will need to recognize a cost of sales of 250, a revenue of 250. Meaning thereby no profit, no loss is recognized in the profitability. No profit, no loss is recognized. Why? Because it is uncertain. So why to recognize any profit? Whatever is the cost incurred is your cost, is your revenue, both. Is that clear, everyone? So we discussed profit making contracts. We discussed uncertain contracts. We have not discussed loss making contracts. But before we discuss loss making contracts, first of all, please tell me, is profitable and uncertain clear to all of you? Is profitable and uncertain clear to all of you? You want me to take up an example of profitable? Okay, let me take it up. Let me take up an example and explain also. For a profitable contract, let's suppose the contract is for 3 years. I'll write here example for profit making contract. Understand? Contract price is $1,000. Okay. Now here, based on input method, total estimated costs is 800. total estimated cost is 800, and here in this year we incurred a cost of 250. So now tell me here, what is the percentage of completion? It is 250 divided by 800. How much? 250 divided by 800 is how much? 31.25%. So what is the revenue that you will recognize? Revenue will be 31.25 into 1000 is 3125. Cost will be 250. Okay. Now again, let's suppose in the next year, this year, the cost incurred is, let's suppose, 300. Cost incurred is 300, and we expect that total in the future estimated costs to complete the project will be 350. 250 plus 300 plus 350. Okay. Now tell me, what is the percentage of completion? What is the percentage of completion? So tell me, what is the cost that we have incurred so far? 550 divided by what is the total cost? So cost incurred so far plus cost that will be incurred in the future. How much? 550 divided by 900. It becomes 61.11 percentage. This is your percentage of completion. So what is the revenue? Revenue will be contract price is 1000 multiplied by 61.11%. This is the total revenue that has to be recognized till here. Okay. Now, but out of which we have already recognized a revenue of 3125. So what is the revenue that we have to recognize? 1000 into 0.6111 minus 3125. That becomes 2514. So this is the revenue which we have to recognize. Now, what is the cost that we have to recognize? Tell me. Just a minute. I think I made some mistake. Yeah. I made some mistake. Yeah. I think so. This would be not 3125. This would be 312.5. This should not be this. Just a minute, guys. I think I did some calculation mistake. I'm so sorry for that. It will be 251.4. It will be 251.40, and here it will be 300. Cost will be 300. Cost will be 300. Not a challenge. See, overall, is the overall contract a loss making? Tell me, Chahit, is the overall contract a loss making? Is the overall contract a loss making? No. Overall contract is not loss making. Okay, still if you want me to change the data, I can do that, but I think it's fine. Okay, overall contract is not loss making. That's just that some estimates have changed. Why? Because see, here you estimated total cost to be 800. Now here, as per the revised estimates, you have already incurred 550. You will additionally incur 350. So 550 plus 350 is how much? 900. Right? The cost has increased, but still the contract is a profitable contract. The overall contract is still a profitable contract. So you are not required to do anything else for that. So you will record revenue and cost like this. Is that clear, everyone? Is that clear, everyone? So this is how we have to recognize the revenue and the cost of sales. I believe you are understanding it fairly. Now, moving on to the loss making contract. But come on guys, tell me, before we move on to loss making contract, is profitable contract and uncertain contract clear, everyone? Is profitable contract and uncertain contract clear to everyone? Come on guys, come on. Okay, now let us move to loss making contract. Let us now move to loss making contract. Now understand. Jeet Sarkar. Now, under loss making contract, if a contract qualifies to be a loss making contract, then in that case, we have to see what. Okay, first of all, if the contract is a loss-making contract, then recognize revenue and cost of sales as per input method or output method. Okay. Okay. First of all, even if it is a loss-making contract, then recognize revenue and cost of sales as per input method or output method, whatever is given in the question. Once you have done that, then come to the accounting for loss making contract. Now understand what you have to do here is you have to calculate what is the total loss. Then compare what is the loss that you have already recognized. Then calculate what is the loss that we have not yet recognized, but it will be incurred in the future. Now understand, this loss that will be incurred in the future is a future operating loss, but the contract is a binding contract. The contract is a binding contract, means can we avoid that future loss? Can we avoid that future loss? No. So this means it becomes an onerous contract, a loss making binding contract, an onerous contract, and hence we have to provide for the onerous contract. Now, while studying IAS 37 on provision, you would have studied that we do not make any provision for future operating losses, right? And that is correct. But if the future operating loss is binding and we cannot avoid that, then in that case it becomes an onerous contract and we need to provide for that. Okay, if the future operating loss is in the nature of an onerous contract, then yes, we do need to recognize for the same. That's what is being done here. See, first of all, standard says that recognize revenue and cost of sales as per input method or output method, whatever is the scenario, you can recognize as per that. Then additionally, compare total loss, calculate what is the loss already recognized in P&L, then calculate what is the loss yet to be recognized, okay, which is called as onerous contract. Now, this is the journal entry which we have to pass for the same. Cost of sales account debit to provision for onerous contract. Now let us take up an example for the same loss making contract. So let's suppose we have a total contract price of 1000, estimated cost of 800. The profit is 200. Ideally, a contract was a profitable contract. Now, in the first year, we calculated the percentage of completion to be 25%. So what will I do? I will recognize a revenue of 250. I will recognize cost of sale of 200. And I record a profit of 50. Is that a challenge? No challenge. Now, in the second year, I incurred a cost of 500. Okay, and I estimate that in the future, in the third year, I am required to incur further 600. Now calculate contract price 1000. Okay. Now costs 200 plus 500, 700 plus 600, 1300. Oh, it's a loss making contract. Overall loss of 300. It's a loss making contract. So now, first of all, what we will do? We will compute the revenue and cost of sales as per input method or output method as the question specifies. Now, so we computed the percentage of completion to be 54%. So now tell me, what will be the revenue? Tell me. Normally, forget loss making. Tell me normally what should be my revenue, what should be my cost of sales. Revenue will be 1000 into 0.54 minus 250. So your revenue will be 290. I believe it is clear. Your revenue will be 290. I believe it is clear. Now, what will be your cost of sales? The cost incurred in the current year, that is 500. So what is the loss? 290 minus 500 minus 500, that is 210 is the loss that you record here. Now tell me, what is the total loss? 300. What is the loss that you've already recognized? 210. What is the loss that will be incurred in the future, third year? 90. So what is the accounting? For this 90? So we'll write cost of sales account debit to provision for onerous contract. How much? 90, 90. And now what we do here is we add up 90 here. We add up 90 here. We add up 90 here. And when we add up 90 here, the loss that we record is not 210. The loss that we record is 300. The entire loss we are preponing and recording it now. Why? Because it is a onerous contract. Why? Because it is a onerous contract. Now, Jeet Sarkar, you are asking me the computation of 290. Let me give you the computation of this 290. Tell me what was the contract price? 1000. What is the percentage completed? 54%. So this is the revenue, cumulative revenue that should be recognized ideally. Minus, what is the revenue that we have already recognized? 250. So can you please compute? 1000 into 0.54 minus 250 becomes 290. Is it clear, everyone? Is it clear, everyone? Come on, guys, please check and tell me, is it clear, everyone? Is it clear, everyone? Guys, it is a very important concept. A very, 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 very important concept for both FR and SBR students. Each concept which I'm discussing today is equally important for both FR and SBR. Muralidhar is asking, isn't it a provision? Yes, it is a provision. But whenever you record a provision, you have to record a corresponding expense in P&L also. You have to record a corresponding expense in P&L also, right? There is always a double entry that we pass. Provision is a SOFP item. What is the impact in P&L? An expense. An expense, right? Now, it's an operating expense. So that's why we add up to the cost of sales. Okay? Now, topic number 5 coming from tax. Topic number 5 is coming from tax. Now understand, what do we need to discuss from a tax perspective? What do we need to discuss from a tax perspective? So understand, this topic is particularly more from a FR perspective. This topic is more from an FR perspective. So understand. So tax is, but yes, deferred tax part is equally applicable for SBR students also. Now understand, tax expense, as we know, has two components: current tax and deferred tax. Current tax and deferred tax. Okay, now current tax, how we need to recognize current tax in P&L and what will be recognized in SOFP? Understand, charge for the current year, charge for the current year plus over provision in the previous year, that is credit balance in the trial balance, minus under provision in previous year, minus under provision in previous year, that is debit balance in trial balance. Okay, this will be the expense that has to be recognized in P and L. Now, what will go in SOFP? In SOFP, you will have to recognize the charge for the current year. Only this will be recognized as a liability in the P and L. Only this will be recognized as a liability in the P and L. Or SOFP, sorry. This will be recognized as a liability in SOFP. Liability in SOFP, or if it is a tax refund, that has to be recognized as a current tax asset in SOFP. If it is a tax refund, that has to be recognized as a current tax asset in SOFP for the current year. Okay. Now, so this is from the point of view of current tax. Now, deferred tax. How do we compute deferred tax? Understand. For deferred tax, we need to compute carrying amount, we need to compute tax base. Okay, carrying amount, tax base. The difference of the two is temporary difference. Now, if this temporary difference increases future tax payments, if this temporary difference increases future tax ka payments, it is a taxable temporary difference. If this temporary difference decreases future tax ka payments, if this temporary difference decreases future tax payments, it is a deductible temporary difference. Now understand, from taxable temporary difference, we create deferred tax liability. From deductible temporary difference, we create deferred tax asset in SOFP. The movement between the opening and closing deferred tax, the movement between the opening and closing deferred tax can go to P&L, OCI or equity depending on where does the base transaction go. Let's suppose if the deferred tax is arising on account of depreciation, Now tell me, where does depreciation gets accounted? P&L. So the deferred tax account will also be done in the P&L. Let's suppose the deferred tax is arising on account of revaluation of a non-current asset. So now tell me, where do we record revaluation of a property, plant, equipment? In other comprehensive income. Hence the deferred tax impact will also go to other comprehensive income. Okay, now for a deferred tax, the challenge that comes up is how much amount should go to SOFP, how much amount should go to P&L, and how much amount should go to OCI. So understand, the entire amount of closing deferred tax liability will go to SOFP. I'm repeating again, please listen to me, very important guys. The entire amount of deferred tax liability, the closing deferred tax liability will be accounted for in SOFP. Okay, now specifically for OCI items, the deferred tax impact will go to OCI. The rest everything will go to P&L. Okay, so understand, I have made a formula and this formula will work in all the cases. Understand, for the amount that will go to P&L, closing deferred tax minus opening deferred tax is the total movement, out of which what is the amount that goes to OCI, what is the amount that goes to equity, rest everything goes to P&L, rest everything goes to P&L. I believe this is clear. Now to explain this, I have taken the help of a question also. Understand, Ewington, this question is from FR, but it will equally help SBR students also. This concept or this question is from FR, but it will equally help SBR students also. So let me explain and you guys please listen to me carefully. Ewington company's trial balance show a debit balance. Now debit balance means what? Debit balance brought forward means what? Under provision in previous year. It means under provision in previous year. Under provision in previous year. And a credit balance of deferred tax. So ignore deferred tax as of now. Guys, understand, whenever you are calculating tax expense, whenever you are computing tax expense, see current tax and deferred tax separately. See current tax and deferred tax separately. See them separately. Now understand, debit balance of current tax. So I'm discussing only from the point of view of current tax. Tax charge for the current year is 16.2 million. So now tell me, what is the amount that will go to P&L? 2.1 plus 16.2 is 18.3. 2.1 plus 16.2 is 18.3 million will go to P&L. What is the amount that will go to SOFP? It will be 16.2 as current tax liability. I believe it is very much clear to everyone. Okay, now coming from the point of view of deferred tax, coming from the point of deferred tax. So its question says deferred tax brought forward balance is 5.4 million, meaning the opening balance of deferred tax is 5.4. Opening balance of deferred tax is 5.4. So I'm writing here, see, opening deferred tax liability is 5.4. Now understand, when it says credit balance means deferred tax liability. When it says debit balance of deferred tax means deferred tax asset. Be mindful about this. Be very much mindful about this. Small one word here and there, entire marks gone. One word here and there, entire marks gone. So be very careful, guys. Be very careful. Now, opening is this much. Now the question says the carrying amount of the net assets is 13 million in excess of their tax base. Carrying amount versus tax base difference of 13 million means it is temporary difference. Now, since carrying amount is more than the tax base, it means what? Tell me, taxable temporary difference or deductible? Tell me guys, come on. Carrying amount is more. It is a taxable or a deductible? Tell me. Since carrying amount is more, it becomes your taxable temporary difference. Okay, it becomes your taxable temporary difference. Though I have discussed the entire logic of it in our regular lectures, but still to help you from an exam perspective, if the carrying amount is more than tax base for an asset, it is a taxable temporary difference. For liability, if carrying amount is less than tax base, then it is a taxable temporary difference. For deductible temporary difference, it is just the reverse. For asset, if carrying amount is less than tax base, it is deductible temporary difference. For a liability, if carrying amount is greater than tax base, it is a deductible temporary difference. Okay. Now, coming back to the question, since carrying amount is more of an asset is more than the tax base, it is a taxable temporary difference of 13 million. Hence, the deferred tax liability will be 13 multiplied by, what is the tax rate? 30%. Which will be 3.9 million is the closing deferred tax liability. Now the question says that in this 13 million, there is a 3 million, there is a 3 million ka revaluation surplus on the first time revaluation of the building. Now tell me, revaluation of building, where will the impact go? Other comprehensive income. So where will the deferred impact, where will the deferred tax impact go? Other comprehensive income. Other comprehensive income, right? So 3 million multiplied by 30% is 0.9 million. This will go to other comprehensive income as deferred tax charge. As deferred tax charge. Okay. Now, what is the amount that will go to P and L? Apply my logic. Apply my logic. Tell me, guys. Come on. How do we compute that? How do we compute that? Tell me, what is the closing? 3.9. What is the opening? 5.4. See here, closing is 3.9, opening is 5.4. This is the movement during the year. Now, what is the amount that gets transferred to other comprehensive income? 0.9. So what is the amount that will go to P&L? 3.9 minus 5.4 minus 0.9 is negative 2.4. Now, what is the meaning of negative 2.4? It means deferred tax credit. It means deferred tax income, tax income, tax income. So how are we going to present that in P and L? So in P and L, tax expense, we have two components, current tax and deferred tax. So current tax is 18.3. Current tax is 18.3. Deferred tax is negative 2.4. So the expense is 18.3 minus 2.4. That becomes 15.9 million. Is a total expense that goes to P and L. Now, in other comprehensive income, we record a revaluation gain of 3, deferred tax impact of 0.9, and hence the net amount of 2.1. The net amount of 2.1. Now, in SOFP, you record two things. Understand? You will record revaluation reserve. How much? 3 million. You will record revaluation reserve 3 million. Okay, under equity. Equity, other components of equity, revaluation reserve. Then under deferred tax liability, you will record 3.9. Under current tax liability, you will record 16.2, right? 16.2. Okay, now see, I have discussed from entire everything, P&L, OCI, SOFP, everything. Now you have to answer according to the need of the question. Whatever the question asks for it, you have to write everything. But I want to say something. Guys, understand. What I'm saying now is very, 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 very important for both FR and SBR students. If the question says deferred tax credit, question is trying to say negative deferred tax or deferred tax income. Okay. If the question says deferred tax credit, it means deferred tax income. But if the question says credit to the balance of deferred tax, it means deferred tax liability. Are you understanding it? Are you understanding it? If the question, I'm writing it here also. Note, I'm writing it off here. Note, if the question says deferred tax credit, it says deferred tax income. But if the question says credit to the balance of deferred tax, it means deferred tax liability. I hope you are understanding this point. Many students do make mistake here. Clear everyone? Clear everyone? Now moving on to the sixth topic, research and development costs. Now understand, for from an IAS 38 perspective, IAS 38 on intangible assets, IAS 38 on intangible assets, we have something called as internally generated intangible assets, right? Now understand, internally generated intangible assets have three phases: research phase, development phase, and developed phase. All of us know one thing, that the cost incurred in the research phase is transferred to P&L. The cost incurred in the development phase, okay, in the development phase is capitalized. Okay, now this everyone knows, but many a times question do try to manipulate with the information. Question do try to manipulate with the information. Okay, question says that we started the project on this particular date. We started the project on this particular date. Now let's suppose on 1st April 20x1 we started the project. On 1st July 20x1 the directors were okay. Now understand, the project entered development phase. So I'm writing it off here. I'll better write and explain. I'll better write and explain. On 1st April 20x1 started incurring costs. On 1st July 20x1 entered development phase. On 1st September 20x1, on 1st, directors became confident of success of project, and on 30th of November project got completed. Okay, now how to deal with this situation, guys? Understand, even though question writes here enter development phase, still it is not development. This is your research phase. This is your research phase. And all the expense incurred here will be transferred to P and L. Okay, now and here they entered the development phase. Here they actually incurred the development phase. Here they actually incurred the development phase, and here we have to capitalize. This is what I wanted to discuss here, because many students were making a mistake here. Many students were making a mistake here. Okay, and now understand. Though this topic what I'm discussing here is very easy, but still, since I've discussed this topic, I want to take it up. Under a research phase, all the expense that is incurred will be transferred to P&L. Under development phase, when we enter development phase, when all the conditions are satisfied, that is probable future economic benefits, intention to complete, resources to complete, ability to complete, technical feasibility, and expenditure can be measured reliably. When all these conditions get satisfied, we enter the development phase. Now when we enter the development phase, we capitalize the costs incurred. There is no amortization as of now. Why? Because it is still under development phase. But impairment has to be done annually. Now tell me, guys, there were three assets for which we do annual impairment. Can you name them? There were three assets for which we do annual impairment. Can you name them, please? One, intangible assets under development phase. Second is goodwill. And third is intangible assets with indefinite useful life. Okay. Now these three assets has to be impaired annually, irrespective of whether impairment indicator exists or not. Okay. Now, when the assets are completely developed, then do we need to capitalize any costs? No. We just need to amortize over the useful life. We just need to amortize over the useful life, and impairment has to be done only if the impairment indicators are triggered. Okay. So this is a three phase for research and development costs, which I have written here. You can read it again from here also. Okay. Now, moving on to topic number 7. Topic number 7, lease deposits. Generally, I have seen students making mistake here. Generally, I have seen students making again a lot of mistakes here. What is the treatment of deposit paid by lessee to lessor? Come on, guys, tell me. Can you please tell me what is the treatment of deposit paid by lessee to lessor? Treatment of deposit. Treatment of deposit. Now understand. If it is a non-refundable deposit, we just need to add it to ROU asset. Okay. Now understand. I've taken up a question and I'll explain this also. On 1st October 20x1, Fresco acquired the right to use an item of plant under a 5-year contract. The contract meets the definition of leases. The term of the contract required an immediate deposit of 2 million. Immediate deposit of 2 million with 5 payments of 6 million paid annually in arrears, commencing on 30th September 20x4. The present value of the future lease payments. So present value of future lease payments is 22745,000. So this is your lease liability. This is your lease liability. Now we add up deposit. How much is the deposit? 6 million. This becomes your ROU asset. This becomes your ROU asset. 22745,000 plus 6. It becomes 28745,000. And the journal entry will be ROU asset. Account debit 28745,000 to lease liability 22745,000 to bank. Bank how much? 6 million. Simran Preet Kaur is asking, can we pass by watching these live sessions only? Simran Preet Kaur, these are important topics. कैसी बातें कर रहे हो आप सिमरन प्रीत कौर? ये important topics हैं, okay, which will help you in the revision of few critical and important topics. To pass the exam, you have to study the entire syllabus, okay? Or if not, at least watch my SBR 15 hours revision video. But you have to study entirely in depth, everything. Okay, now, so this is from the point of view of non-refundable deposits. Coming to topic number 8, refundable grant related to asset. Just give me a minute. I'll add a page here and I'll transfer all of these to the next page. And I'll discuss here. Now tell me, when the grant is refunded, what is the accounting of it? When the grant is becomes refundable, What is the accounting treatment of it? Definitely, we need to recognize grant repayable, whatever is the amount of it. Whatever is the amount of it. Now understand. First of all, we need to adjust it from where? Tell me. First of all, we need to adjust from where? If we have the deferred, grant income available, if we have deferred grant income available, then we adjust it from there. First of all, we adjust from there. Then any excess is adjusted from P and L. But this happens if it is a grant related to income or grant related to asset accounted under gross method. Under gross method, what we do? We account for asset and the grant separately. So when we do the accounting for grant separately, we do recognize the whole amount of grant received as deferred grant income, and over the grant period, we recognize grant income, right? But what if we have a grant related to asset under net method, where in which case we would have adjusted the whole amount of grant received from the cost of the asset. So definitely, first of all, we will recognize grant payable. Grant payable will recognize definitely. Now, tell me, when we received the grant, what we did? We decreased the value of the asset. So now we have to increase the value of the asset. Now, initially, since we decreased the value of the asset, we charged less depreciation also, because if the value of the asset reduces, the depreciation also reduces. Now, since the grant becomes repayable and we are increasing the value of the asset, so depreciation should also increase. So this is the entry for a grant related to asset under net method. Now, student generally makes a mistake in this question. In this question, they do make a mistake. So I want to discuss this part in my discussion. I want to take up a question on this part. Okay. Now, chalo, I have taken up a question. Now, this question is ideally from an SBR FR perspective, but it is equally applicable and helpful for both FR and SBR students. Okay. So let me discuss the question and the logic both. On 1st January 20x6, Garden Bucks received $30,000 government grant relating to the equipment that cost $90,000 and has a useful life of 6 years. So we have received a grant of how much? We received a grant of 30,000. Cost of the asset was 90,000. Life was 6 years. The grant was netted off against the cost of the equipment. So now what we are doing here? We are following net method. This one, net method. Okay. On 1st January 20x7. Hold on guys. Now see here. On 1st January 20x6, when we received the grant, 90,000 was the cost of the asset. We received the grant 30,000. Since we followed net accounting, we netted the value of the asset and we recorded the asset at 60,000. Life was 6 years. So we will be depreciating 60,000 over 6 years. Hence the depreciation becomes how much? 10,000 per annum. 10,000 per annum. Now the question says what? On 1st January 2007, when the equipment had a carrying amount of 50,000. Why? On 1st January 2007, after 1 year, 60,000 minus 10,000 is 50,000. The question says, when the equipment had a carrying amount of 50,000, its use was changed so that it was no longer being used in accordance with the grant. This meant that the grant need to be repaid in full, but by 31st December 2007, and this has not yet been done. So how will it be accounted for? So what we'll say, see, what is the accounting that we have done? What is the accounting that we have done so far? 60,000 is what we have recorded. 10,000 is what we have depreciated, and 50,000 is what we are accounting for now on 1st January 20x7. Okay, now, but what should have been the accounting if there was no grant? 90,000 minus 15,000, because 90,000 by 6, 90,000 by 6 is 15,000 should be the depreciation, and the carrying amount should be 75,000. So on 1st January 20x7, we will record the entry as asset account debit 10,000, not 10,000, sorry, just a minute. We will record on 1st January 20x7. On 1st January 20x7, we will increase the value of the asset by 25,000. We'll increase the depreciation by 5,000, and we'll record a grant payable of 30,000. This is the entry that has to be done on 1st January 20x7. But let's see the question. Question is asking us to pass the entry on 31st December 20x7. So now tell me, during 20x7, what is the entry that we will pass? We'll record depreciation also. So now in the current year, we'll record depreciation. How? Depreciation account debit to asset. In the current year, I will record a depreciation of 15,000. The correct depreciation. The correct depreciation. In the current year, we'll record the correct depreciation. Right? Now the question is asking what is the treatment that we'll do for the entire year of 20x7. So what we have to do? We just need to accumulate these two entries. Can you do that? Can you please accumulate these two entries? So what is the journal entry that comes up when you accumulate this? So depreciation is 5, depreciation is 15. So depreciation account debit 20,000. Now asset is 25 debit, asset is 15 credit. So asset is debited net by 10,000 to grant payable 30,000. I believe you are understanding this question. A very, very important, very, very important question. Okay. I believe it is clear to all of you. Okay. Chalo. Now, moving on to the next adjustment, that is exchange gains or losses. Exchange gains or losses as per IAS 21. As per IAS 21, what is the treatment of exchange gain or loss? So now, first of all, let me explain the treatment. Understand, whatever is the exchange gain or loss, irrespective of whether it is a realized exchange gain loss, whether it is a realized exchange gain or a loss, or it is unrealized exchange gain or loss, both of them will go to P and L. Both of them will go to P and L. I believe it is clear. Now comes the question, sir, what is the meaning of realized and what is the meaning of unrealized? You will understand by the help of this question. So understand, Michelin companies buys goods priced at $50,000 from a Dutch company, and the invoice is due to be settled. So when on 1st November 20x8 the purchase is made, and you have a payable of how much? Euro. You have a payable of how much? Euro 50,000. Okay. Now, the functional currency is dollars. Okay. Whether mentioned in the question or not, assume it to be dollars. Okay. If the question mentions any other functional currency, then you should take that. But if the question is silent, take dollar as the functional currency. Okay. Now, question says that this payable of Euro 15,000 is a foreign currency payable, and hence a foreign currency monetary item, and it has to be restated at the revised exchange rates at every reporting dates. Now, it has to be payable on, a part of it has to be payable on 31st December 20x8, and the part of it has to be payable on 1st January 20x9. Our reporting date is 31st December 20x8. Okay, now so 50% here, so we will pay euro 25,000 here, and here on this date we will have a payable. We will have a payable of euro 25,000, and it will be paid here. Euro 25,000 will be paid here, paid here, paid here. Okay, now understand, on the date of the transaction, on the date of transaction, tell me how much dollar payable shall I record? On the date of transaction, how much dollar payable shall I record? On first number, the dollar is, for every $1 we have to pay how much? Euro 1.63. So tell me which currency is stronger, euro or dollars? Which currency is stronger, euro or dollar? Dollar is stronger. Dollar is stronger, right? So $1 is equivalent to 1.63 euros. So dollar is stronger. Guys, do you need to understand how do we find which currency is stronger? So always think like this. $1 can handle 1.63 euros. Tell me which one is stronger. $1 can handle 1.63 euros. Which one is stronger? Definitely dollar, right? Like one person can handle 1.63 persons. So which person is stronger? The one, right? Now, so this is stronger. So to convert into dollars, we have to divide. So always understand, whenever you are coming from weaker to stronger, divide. Whenever you are coming from stronger to weaker, multiply. So 60,000 divided by 1.63. 1.63. You record 30675. $30675 payable. No, Sunaina, dollar is stronger. Dollar is stronger. $1 can handle 1.63 euros. If let's suppose, understand, let me explain. Let's suppose there is a movie going on. Okay, SRK is the hero, right? He is trying to fight with the villain. To save the heroine. Okay, now understand, SRK alone is fighting with 10 villains. Tell me who is strong, SRK or the villains? Who is strong? Tell me. SRK alone is fighting with 10 villains. Who is stronger? Tell me, SRK or the villains? SRK, right? Because one person is handling 10. So definitely this person is strong. Okay. Similarly, dollar alone is handling 1.63 persons, right? So dollar is stronger. Now, here on this date, tell me, what is the dollar payable that we have recorded? We are paying 50% of it, right? We are paying 50% here, and we are paying 50% here. So tell me, what is the dollar payable that we have recorded? 30675 divided by 2. We have recorded 15338 is what should be paid. But now tell me, what is the amount that we are actually paying? Tell me. So what is the exchange rate on this date? 1.61. 1.61. So 25,000 divided by 1.61 is how much? 15528. We are paying 15528. So now tell me, oh, we incurred a loss. We have recorded a payable of this much, but we are paying this much. So how much? 15338 means we get a loss of 189. We get a loss of 189. So now understand, this loss is a realized loss. Why? Because this loss we are getting on the payment. It is a realized loss. It is a realized exchange loss, and it will go to P&L. Okay. Now, on this date, on 31st December 20x8, we have a payable of this much, but are we paying it now? No. Are we paying it now? No. So we will paying in the next year. So we have to restate. But before we restate, tell me what is the value at which it is recorded in our SOFP. 15338 is the value at which it is recorded as of now. But when we restate, we say 25,000 divided, what is the balance as on today? 1.64 divided by 1.64. It is 15244. 15244. The value of the payable reduces. And we get a loss gain of 95 gain. And this is a unrealized. This is an unrealized exchange gain. This is an unrealized exchange gain. This is an unrealized exchange gain. But whether it is realized or unrealized, irrespective of that, it will also go to P&L. It will also go to P&L. So in P&L, what is the amount it will record? 189 ka loss minus 95 gain. Net amount is 189 minus 95 is 94 loss is what we are going to record. I believe it is clear to everyone. I believe it is clear to everyone. Now, moving on to topic number 10 from the cash flow statements. Guys, understand, at FR level, this is a gain, na? Ji Sarkar, it is a gain, na? We had a payable recorded at 15338, but the payable reduced to 15244. So it is a gain. The payable is reducing, is a gain. The payable is reducing, the payment is reducing, the payable is reducing, is a gain. Okay, 95 is a gain. Now, loss minus gain is net loss. Now, no, the payment amount was 1.15338 was the carrying amount. But the restated amount is 15244. Means if I have to pay today, I will have to pay this amount. I will have to pay this amount. I will have to pay this amount, right? If I have to pay this amount and we have recorded at this amount, so it's our gain because the payment amount has reduced. It's our gain. Okay. Now, topic number 10 is from cash flow statements. At FR level and at SBR level, both cash flow does become an important topic. Okay, but cash flow is ideally at FR level, generally I have seen, is not tested full-fledged. Ideally, so far it has not been tested full-fledged in the exam. Yes, it is tested as part of section A or section B or an extract of it in section C. But in cash flow, what I have seen, students are able to fairly deal with it. Okay, but at some point they do struggle. And the major point where they struggle is property, plant and equipment. So I want to discuss that topic here. Now guys, tell me how you have to deal with it. The process is quite very simple. Understand? Now from this PPE information given, what you have to do is only one thing. See, from the PPE account in the cash flow, we can get only two things. One is the sale proceeds from the sale of an asset, and one is the cash paid to acquire a new asset. Okay, so now understand how to do that. So always follow this structure. What I'm taking now, always follow the structure. You will never make any mistake. Tell me, what is the opening property, plant, equipment? Opening is 657. Okay, now plus what is the, now just see the information and do plus minus. During 20x8, an item of property, plant and equipment with a carrying amount of 103 were sold for 110. Now tell me, this property, plant and equipment, we adjust what? Only carrying amount minus carrying amount of asset sold is how much? 103. Always deal only with carrying amount here. Then what? Profit on sale is netted off with operating expenses. Okay, we'll deal with it. Depreciation minus depreciation is 47 minus. Now minus revaluation. Minus revaluation is 100, not minus, plus. Revaluation will increase the value of the asset, plus 100. So now tell me, what is the carrying amount? What is the closing PPE? What is the closing PPE? 657 minus 103 minus 47 minus 100. Sorry, minus plus 100. 657 minus 103 minus 47 plus 100 is 607 is the closing balance. Right? But what is the closing balance given? 799. Closing PPE as per question is 799. So what is the difference? Minus 799 is 192. This is the, now understand, the closing balance that you are getting is 607. The closing balance given in the question is 700. More. Why more? Because this is the acquisition of new asset. Acquisition of new PPE, and it is a cash outflow. So now how will you present in the cash flow statements? How will you present this in statement of cash flow? Understand, this is the statements of cash flow. I am discussing particularly investing activities. So here you write cash paid to purchase property, plant, equipment is 192, is an outflow negative. Is an outflow negative. Now you can see that some asset was sold also. Sale proceeds. What was the sale proceeds? See, understand, the inflow is not the profit. The inflow is not the profit. Inflow is the sale proceeds. Cash inflow is the sale proceeds. So understand, the carrying amount was 103 and the profit that you made, okay, and it was sold for 110. So ideally the profit made is 7,000. But what is the amount that will go to cash flow statements? So sale proceeds is 110, which will go here, sale proceeds. Not profit. The whole amount of sale proceeds is your cash inflow. The whole amount of sale proceeds is your cash inflow. The whole amount of sale proceeds is your cash inflow. I believe you are understanding this concept. I believe you are understanding this concept of statements of cash flow. Now moving on to the next concept of deferred consideration. Now understand deferred consideration. So what happens? Many a times we see in the question it is given that a parent company had acquired a subsidiary by paying cash consideration, by paying deferred consideration, but the parent company has forgotten to recognize the deferred consideration, right? They have forgotten to recognize the deferred consideration. They have forgotten to recognize the deferred consideration. How will that be accounted? How will that be accounted? So understand, on the date of acquisition, you have to first of all rectify the investments. How? First of all, compute present value of deferred consideration. Compute present value and add to investments. Okay, while calculating goodwill. Add to investments. Point number one. Now, reporting date, on the date when you are preparing the SOFP or the P&L. So understand, from what is the treatment? Now you have to understand, in if the question is from the P&L perspective, if the question is from SOP&L perspective, add unwinding finance costs on unwinding, add finance cost on unwinding to finance costs. Okay, but if the question is from SOFP perspective, then what will you do? Two things. One, reduce finance costs from console RE. And students, do make this mistake, guys, but I strongly recommend you to keep this in mind. Then the deferred consideration in SOFP that you record will be equals to present value on date of acquisition plus the finance costs on unwinding. Is it clear, everyone? Is it clear, everyone? Come on, guys, tell me. Is it clear, everyone? Okay, chalo. Topic number 12. Intra-group trading with subsidiary. Let me discuss this part also. A very easy, but yes, students does make a mistake here in posting the amount. So understand. Let's suppose if parent has sold the goods to subsidiary. Tell me who has earned the profit. Parent. And now, where do we record the profit of parent? Console RE. So journal entry will be console RE account debit. And who has the inventory? Subsidiary. So we have to reverse the inventory. By what amount? By amount of unrealized profit. By amount of unrealized profit. Okay. Now, what is the amount of unrealized profit? Unsold goods lying with S. Unsold goods lying with S multiplied by profit charged by P. And guys, one more thing, be mindful of markup and margin. Markup is applied on cost, margin is applied on sales price. But if subsidiary, understand, if subsidiary sells the goods to parent, so definitely we will do to inventory. But now tell me, who has earned the profit? Subsidiary. Who has earned the profit? And where is the profit of subsidiary recorded? Post acquisition. Now, and the post acquisition profits of subsidiary gets allocated to parent and NCI in the ratio of their shareholding, right? Now, where is the parent's share of profit goes? Console RE. Where does NCI share of profit go? NCI. Okay. By amount of unrealized profit. And how will you compute the unrealized profit? Unrealized profit is unsold goods lying with P that was purchased from subsidiary, okay, multiplied by profit charged by subsidiary. Guys, understand, when I say unsold goods lying with P, okay, it means unsold goods lying with P that was purchased from subsidiary. Okay, please don't make a mistake of taking the whole of the inventory of parent. No, when I say unsold goods lying with S, I means unsold goods lying with S that was purchased from parent. Don't take the whole of inventory of S. Okay, I believe this entry is clear to all of you. Now, This is the treatment if it's a question of console SOFP. What if in the exam a question from console P and L comes up? If a question comes up in the exam from console P and L, then what will you do? From revenue and cost of sales, deduct the entire amount of intra-group trading. Deduct the entire amount of intra-group trading, whole of it, whether sold or unsold, irrespective of that, the whole amount, and add unrealized profit to the cost of sales. Because unrealized profit we have to reverse. We have to reverse the profit. We have to reduce the profit. To reduce the profit, we have to increase the cost of sales. That's why we are adding the unrealized profit to the cost of sales. Okay. Now, I believe this is clear to all of you. I believe this is very clear to all of you. Just understand one thing. If parent sells to subsidiary, parent's profit is recognized in console RE. So we debit console RE. If S sells to parent, subsidiaries profit is recognized in the post acquisition column of the allocation of net assets. Now the post acquisition profits of subsidiary is allocated to parent and NCI in the ratio of their shareholding. So parent's share is recognized in console RE, NCI share is recognized in NCI. Hence I have written here. Now in my classes I would have written sometime post acquisition share of profit, right? I would have written that. Yes, that also will be allocated to parent and NCI in the ratio of their shareholding. Again, so the net impact is this only. That's why I've written it here directly. Now, coming on to the next adjustment, that is contra adjustment. The next adjustment, that is contra adjustment. Why do you need a break? We have our exam in next 7 to 8 days. So let us study. Let us study, guys. Okay. Till the time we have the energy, we will study. And we'll complete the sessions as soon as possible so that you can revise it effectively also. Guys, again, I'm telling, if you need the notes of this session, it is there. It will be provided after the class in my Telegram group. It will be provided after the class in my Telegram group, the link of which is already pinned in the chat box. Okay. It will be also be there in the description box of this video. Now, contra adjustment. Contra adjustment. Understand. Parent has a receivable from subsidiary $100. Subsidiary has to pay to parent $100. Contra. Knockoff. In while preparing SOFP, reduce trade receivable by 100, reduce trade payable by 100. Why? Because understand, when we prepare group accounts, we always have to keep in mind one thing, that parent and subsidiary is one. We always have to keep one thing in mind, that parent and subsidiary is a single economic entity now. Is a single entity. Parent and subsidiary is a single entity now. Any payable or receivable within them has to be knocked off. Now, case B. Case B. Parent has recorded a trade receivable of 100. Siri, Sant? Siri? Haan. Parent has recorded a trade receivable of 100. Parent has sent goods of $30 to subsidiary. Which subsidiary has not received by reporting date. Subsidiary has not received these goods by reporting date. Now tell me, if subsidiary has not received these goods by reporting date, will subsidiary record a trade payable for the same? If subsidiary has not received the goods, will subsidiary record a trade payable for the same? No. Now here it means the trade payable of subsidiary will be how much? 100 minus 30, that is 70. That is 70. Now, how will you do the contra adjustment? So understand, in the case of this goods in transit case, reduce the trade receivable and trade payable by their carrying amounts. So tell me, what is the carrying amount of trade receivable? 100. What is the carrying amount of trade payable? 70. Reduce trade receivable by 100. Reduce trade payable by 70. Now, what is the goods in transit? 30. So these goods are de-recognized by parent since parent has sold it, but not recognized by subsidiary because subsidiary has not received it. So these goods are somewhere lying in the atmosphere, neither in the books of parent nor in the books of subsidiary, somewhere lying in the atmosphere, right? So now we have to recognize these goods in transit of 30. So now if you see, the net impact becomes okay. Okay. Now similarly, case C. Now understand, parent has to receive certain money from subsidiary, and subsidiary has to pay an amount of money to parent. Subsidiary has to pay an amount of money to parent. Subsidiary has already paid cash of $30 to parent, which parent has not recorded. Why? Because parent has not received it by the reporting date. Then what will be the trade receivable of parent? Tell me. See, understand, when subsidiary pays the amount, subsidiary would have reduced the trade payable. But since parent has not received the amount, parent would not have reduced it. So parent will say 70 plus 30, 100 will be my trade receivable. Now, what will be the contra adjustment? Reduce payable and receivable by their amounts, by their respective amounts. So I will reduce trade receivable by 100. I will reduce trade payable by 70. Okay. Now the difference is cash in transit I will record. So net impact is 70 and 70. Sorted. Case D, bills of exchange. So far this concept has not been asked either in FR or in SBR, but it can be asked, guys, anytime. Okay. So I want to discuss it with you guys. Now understand. Parent has a bills receivable of 100 from subsidiary, and subsidiary has a bills payable of 100 to parent. So ideally, what will be the entry? Parent will reduce trade receivable by 70, subsidiary will reduce trade payable by 70. Not 70, 100. The entire amount of bills receivable and bills payable. But what happened is, out of this receivable of 100, parent discounted bills of $30 with the bank. Okay. Parent discounted bills of $30 with the bank. Now what happens? Parent is recording a bills receivable of $70. Now subsidiary has to pay 70 to parent, and subsidiary has to pay 30 to bank. Now tell me, is a bank a part of the group? Is bank a part of the group? No. So this 30 is payable outside the group. So will that be a part of contra? No. So I will be reducing 70. Clear, everyone? Is it clear, everyone? Okay. Now, moving on to topic number 14, dividend paid by subsidiary. So this condition happen when the bills gets discounted by parent. When the parents discounts a part of the bill with the bank. Okay, this is the triggering situation. Okay, chalo. Now moving on to topic number 14, that is dividend paid by subsidiary. Now understand, when subsidiary pays a dividend, subsidiary will pay a portion of the dividend to parent, and subsidiary will pay a portion of the dividend to NCI, right? When subsidiary pays dividend, subsidiary will pay a portion of the dividend to parent and a portion of the dividend to NCI. Now tell me, when parent and subsidiary becomes one, and parent has received some amount from subsidiary, tell me, can we record income within the entity? When parent and subsidiary becomes one, can we record income within this group? No. So now understand, in the individual FS of parent, when subsidiary gave dividend, parent would have recognized it as an income. Bank account debit to dividend income, right? Parent would have recognized it as income. So now understand, when we are preparing group entity, when we are preparing group FS, we have to reverse it. Reduce console RE, parents profit by the parents share of dividend. Why? Because we cannot recognize income within the group. Okay. Now tell me, what is the meaning of NCI? What is the meaning of NCI? The amount that the group has to pay to NCI. The amount that the group has to pay to NCI. Now, if we actually pay an amount to NCI, don't you think we should reduce NCI for that? Don't you think we should reduce NCI for that? Right? So now what happens if subsidiary company pays a dividend? If subsidiary company pays a dividend, what should be the adjustment in the console FS? The adjustment is very simple. Reduce console RE and NCI in the ratio of their holding. Reduce the dividend amount from console RE and NCI in the ratio of their holding. Sir, the logic, we reduce console RE because we are reducing the income that is recognized by the parent in this individual financial statements. Why we are reducing NCI? Because we are paying an amount to NCI and we are reducing NCI because of that. Point number one. Point number two, understand one more thing. Understand one more thing, guys, here. When we pay off the dividend, the net assets of subsidiary decreases, right? The net assets of subsidiary decreases. So now understand, ideally, when the subsidiary's net assets increases due to profit, we increase console RE, we increase NCI. Now, when subsidiaries net assets decreases due to dividend, so we should decrease console RE and NCI. We should decrease console RE and NCI in the ratio of their holding by the dividend amount. Okay. Now, so this is the treatment of dividend. This is the treatment of dividend. Now moving on to topic number 15 is the disposal of subsidiary. Disposal of subsidiary. Okay. Guys, are you getting a grip of these concepts? Tell me, guys, come on, all of you. Are you getting a grip over these concepts which we are discussing now in the class? Yes, Uday, please tell me your question. See, so far we discussed these were common FR SBR topics. Okay, but we have specific for SBR also. We have specifics for SBR also, these one. Now again, this change in the P&L format is for both FR and SBR. Is for both FR and SBR. So what I'll do is I'll discuss it here itself, so that after this FR students can leave. Kindly suggest a way to revise the whole group in the less possible time. Okay, a roadmap would be better. Understand, whether it is a group accounting of FR or it is a group accounting of SBR, the best way to revise it is from the point of view of just see a console SOFP. Just see a console SOFP, see things. Okay, what is that we need to adjust? Uday, do you remember I gave a console SOFP performa in our classes, right? Prepare that performa yourself. Just think, what can be the adjustment? What can be the possible adjustments? Let's suppose property, plant, equipment, parent plus subsidiary minus plus fair value adjustment on date of acquisition minus excess depreciation. Can anything else be adjusted here? Ideally no. Similarly, go with investments. What can be the adjustments here? Go with share capital. What can be the adjustments here? Go with equity securities premium. Go with NCI. Just do your brainstorming in the Excel file. Do your brainstorming with SOFP, with P&L with cash flow. Do your brainstorming. That's the best way. In my opinion, that's the best way of revising. Once you are done with that, okay, revise from my notes. Revise from my notes. Now, once you revise from my notes, just see, did you miss to account for any of these things in your pro forma? If yes, you missed something, then just check where can we do the accounting for that. That's the best way. I always revise in that manner. Okay, when I was a student, I used to revise in that manner. Okay. The energy has the energy has reduced, guys. Why? Anwar is saying, I saw a question where the research expense of subsidiary is capitalized. Yes, as per IFRS 3, if subsidiary has incurred any research cost prior to date of acquisition, that has to be capitalized on date of acquisition at its fair value. If the group has some value from the research done by the subsidiary prior to date of acquisition. Okay, any research cost incurred by subsidiary after date of acquisition will be expensed off to P and L. Okay, can we take a concept of loss of significant influence? We'll see to that. Okay, we'll just stick to the concept which we have decided. Okay, we will not increase or decrease any of the concepts. We'll just stick to it. Okay. Now, let us take a break of 5 minutes because I can see students, okay, asking for the break. Okay, so let us take a break of 5 minutes and then we'll resume back. Okay, just 5 minutes, no more, not nothing more, nothing less. Okay, 9:07. Can we resume back, guys? Chalo, let's resume back. शुरू करें क्या? Swam, you have a topic to be discussed, that is loss of significant influence. What is the accounting treatment of it? Though it was not a part of my initial plan, but no worries, I'll take it up. But towards the end of the session, I'll not change the plan of my session. I'll stick to my plan. But since you have a query, I'll take it up, but towards the end, not now. Okay, just make sure that you are reminding me. Okay, just make sure that you are reminding me towards the end. I'll definitely take it up. Okay. Now, moving on to what is the accounting treatment when we dispose of the subsidiary? What is the accounting treatment when we dispose of the subsidiary? So now, accounting treatment in the separate individual FS of the parent and in the console FS. What is the treatment? Understand? In the individual FS, we record the investment at its cost. So what we do when we dispose of the subsidiary, we de-recognize investments, we recognize sale proceeds, the gain or loss goes to P&L. The gain or loss goes to P&L. Let's suppose we have disposed of partially. We dispose of partially. So now, do you know whenever the status changes either from subsidiary to associate or associate to investments or investment to associate to subsidiary, whenever the status of the investment changes, so on the date of change of the status, we remeasure the investments at its fair value on that date. So now what happens? Understand, I am giving you the crux. So what happens in the individual FS of the parent company? We de-recognize the entire investments. De-recognize the entire investments. I'll write off here also. We'll de-recognize the entire investments to investments. The whole of it. Now, we will recognize in the bank the sale proceeds. We will recognize the investments retained at its fair value on such date, and then the difference goes to P and L. The difference goes to P and L. Tell me, is this treatment clear, everyone? Is this treatment clear, everyone? Come on, guys, please tell me. Okay, now comes the question, what is the treatment in the console FS, the group FS? Now tell me, when we acquired the control, what is the treatment that we give? When we acquired the control, what is the treatment that we give? We recognize net assets of subsidiary, we recognize NCI, we recognize goodwill, we de-recognize investments. Pakka? Clear? Now, when we are disposing of the subsidiary, that when we are losing the control, we have to do just the reverse. Initially, we recognized net assets, we recognized NCI, we recognized goodwill. Now, we will de-recognize net assets, we'll de-recognize goodwill, we'll de-recognize NCI. Initially, we de-recognized investments. Here, we will recognize sale proceeds. The difference will go to P and L as gain or loss on disposal of subsidiary. As gain or loss on disposal of subsidiary. As gain or loss on disposal of subsidiary. Again, I'm repeating. So in the console FS, on the date of disposal, in the console FS, on the date of disposal, I will de-recognize what? Net assets, NCI, goodwill. I will recognize what? Sale proceeds, investments retained at fair value. Investments retained at fair value. The difference will go to P&L. Is it clear, everyone? Is it clear, everyone? Sir, please, sir. One question. Sir, please, one question. Okay, theek hai. Since you guys are telling me, I'll definitely take it up. Now, Money has a query. Sir, what if we seized subsidiary first and then disposed of? It recognizes IFRS 3 or IFRS 15. First of all, there is no such point of IFRS 15. You're talking from an IFRS 5 perspective, okay? We seize subsidiary. How can we seize subsidiary? Might be we would have lost control before and then we disposed of. It can be the case, okay? So on the date of loss of control, we will do this accounting, okay? On the date of loss of control, we'll do this accounting. The accounting will happen on the date of loss of control. Now understand, I'm taking up a question. Activity 1. Okay. a profit or loss on disposal of subsidiary. Now, okay, rather than explaining the entire question, I have already drawn the diagram of it, which I'll explain. On the date of acquisition, the question gives you net assets, question gives you investments, question gives you NCI, hence we compute goodwill to be 290. Okay. Now, on the date of disposal, we have disposed at 1500. We have disposed the entire investments at 1500. So now what we'll do? We'll de-recognize NCI, we'll de-recognize goodwill, we'll de-recognize net assets. On the values as per this date, the value of net assets on this date, the value of NCI on this date, the value of net assets, NCI, goodwill, the value as on this date will de-recognize. The difference will go to P and L. The difference will go to P and L. Sir, if the values are not given, then the value of net assets will definitely be given in the question. The value of net assets will definitely be given in the question. Now, goodwill ideally remains the same on date of acquisition and date of disposal. Ideally, the goodwill remains the same. Goodwill can change only due to one reason, that is impairment of goodwill. So just see if there is any impairment of goodwill or not. Now, if I have to talk about this question, see, the question clearly says no impairment has been made necessary. There is no such goodwill impairment done. So we have taken the same value of goodwill 290. Net assets value is given. Now, if NCI value is not given, no issues. Value of NCI is given on the date of acquisition. We know the value of net assets here. We know the value of net assets here. What is the change? 460 to 710. 460 to 710. Change is 250. So this 250 has to be allocated to parent and NCI in the ratio of their shareholding, right? This 250 is what? Profit earned by the subsidiary from here till here. So 250 multiplied by what is the NCI percentage? 20%. So 250 ka 20% will be added to NCI. So NCI here was 150 plus 250 ka 20% is 50. So 150 plus 50 is 200. Is the value of NCI on the date of disposal. Is it clear, everyone? So NCI is 200 here. I believe it is very much clear. So we are de-recognize NCI, we are de-recognizing goodwill, we are de-recognizing net assets. We are recognizing sale proceeds. Difference goes to P&L. Now, in standalone FS, in the individual FS, we de-recognize the investments, we recognize the sale proceeds. Difference goes to P&L. So I believe this treatment is clear to all of you. Now, particularly for SBR students, in SBR, they might ask, why do you think that there is a, see, understand, in the individual FS, you get a profit of 900 on disposal. But in group FS, you get a profit of 700 on disposal. Why this difference? You might be required to explain this. In SBR particularly, you might be required to explain this. This explanation can be asked in FR also, but more primarily in SBR. So now what you have to say, understand. In SFS, we are recording 900 profit, right? Now, but in group FS, we are recording 700. Understand? From date of acquisition till disposal date, what was the profit earned? 250. What was the parent share? 80%. So 250 ka 80% is how much? 200. So we have already recorded 200 profit. So 200 plus 700 is 900. 200 plus 700 is 900. Are you understanding? In group FS, we have already recognized this 200 ka profit. Before, during this period, we have recognized. Now we are recognizing 700. But in the individual FS, you are recognizing 900 entire amount here. Okay, because this happens because in the group FS, we keep on recording the share of profit that the subsidiary earns. But that's not the case in the individual FS of parent, right? In the individual FS of parent, we do not record the share of profit of the subsidiary. I believe you are understanding this relation. Okay, chalo. Moving on to the next topic of goodwill impairment loss. Now, goodwill impairment, as I have discussed with you guys already. Understand? if NCI is at fair value method, if NCI is at fair value method, the goodwill that comes up is full goodwill. And if NCI is at proportionate share method, the goodwill that comes up is partial goodwill. Now, what is the meaning of full goodwill and partial goodwill? So full goodwill is for both parent and NCI, but partial goodwill is for parent only. Are you getting my point? Are you getting my point? Full goodwill is for both parent and NCI, but partial goodwill is for only parent. Partial goodwill is only for parent. Now, if goodwill is impaired and NCI was at fair value method, you allocate the impairment loss to parent and NCI both in the ratio of their shareholding, that is consol RE account debit, NCI account debit to goodwill. But if NCI is at proportionate share method, means goodwill was only for parent. So any impairment loss will also be for parent only. Any impairment loss will also be for only parent. That is consol RE account debit to goodwill. Consol RE account debit to goodwill. I believe you are understanding this perspective. Now, one more thing, understand. If a question gives you the amount of goodwill impairment, if the question gives you the amount of goodwill impairment and the question is a P&L question, you have to prepare consol P&L. So what will you do? You will record the entire amount of goodwill impairment in the admin expenses, or operating expenses, whichever head the question asks you to add the goodwill impairment, you add it there, you add it there, you add it there. But when you are calculating the amount of profitability allocable to NCI, adjust goodwill impairment if NCI is at fair value method only. If NCI is at fair value method only. Why? Because if you remember, I have explained in my live classes, that in my regular classes that when you prepare consol P&L, okay, when you calculate the total profitability of the P&L, you have to allocate that amount to parent and NCI. Right now, whenever you are computing the amount allocable to NCI, so what we say, what is the post acquisition profits of subsidiary? Adjust. Now the adjustment items are all the items that impacts the profitability of subsidiary, okay. Now in that adjustment, we take the amount of goodwill impairment also if NCI is at fair value. If NCI is at a proportionate share method, then we do not adjust that by goodwill impairment. Please keep a note of it. Now, coming on to the investment in associates. Guys, come on, tell me, is it clear everyone till here? No. We have discussed disposal of subsidiary also and goodwill impairment loss also. Investment in associate. Add page. Now understand, let's suppose parent has acquired 40% of an associate paying $90,000. What will be the accounting in the books of individual FS of parent and the group FS if net assets on the date of acquisition is 300,000? So now tell me, what is the share of net assets? 300,000 multiplied by 40% is 120,000, right? What is the investment made? 90,000. Just a minute, guys. Just a minute. 200,000. 200,000 into 0.4. Okay. Just a minute. Right here, 200,000. 200,000. And right here, 300,000. So what is the share of net assets? Share of net assets is how much? 200,000 multiplied 40% is 80,000. Okay, and you have made an investment of 90,000. So what happens? Investment is more than the net assets, so goodwill of 10,000. There comes a goodwill of 10,000. Okay, so now understand, in SFS of parent, you will write investment in associate 90,000. Now, In CFS, that is Group FS, you will write investment in A 90,000, and also you will write in the brackets goodwill 10,000. You will just disclose. We don't recognize goodwill, we just disclose goodwill. Tell me, is it clear, everyone? But this is not the concept which I ideally wanted to explain. The whole intent of explaining this is one more concept where I know that you will make a mistake in the exam. Copy. What if the amount is not 200,000, rather it is 300,000? Then what will happen? So understand, what is the investment made? 90,000. But what is the share of net assets that we get? 300,000 ka 40% is 120,000. We get 120,000, right? So now understand, it is a gain on bargain purchase position of 30,000. So how are we going to account for it? So understand, standard says that the investments in associate should a bare minimum reflect the share of net assets. Now tell me, this 90,000 investment, does it reflect the share of net assets? No, share of net assets should be 120,000, but investment is only 90,000. So we should increase the value of investments, and the journal entry that we pass is investment in associate account debit to gain on bargain purchase 30,000. So how will this be accounted in SFS of parent? How will this be accounted in SFS of parent? We'll write investment in associate 90,000. But while preparing group FS, we will write investment in associate 120,000, and we'll write in retained earnings, we'll write gain on bargain purchase 30,000. I believe it is very much clear to all of you. Okay, this is important from an FR perspective, from an SBR perspective. Generally, a student forgets this concept. I don't want you to forget this. Is it clear, everyone? Okay. Now, intra-group trading with associate. Guys, wherever possible, I am taking up examples also so that you understand the concept better. But practically not possible to take example in all the situations. But wherever possible and wherever it is required, I am myself trying to take up examples there so that you understand the concept in a better manner. Intra-group trading with associate. Now, how do we account for intra-group trading with associate? So let's suppose when parent sells the goods to associate, tell me who has earned the profit? Parent. So we will reduce what? Consol RE. Account debit. We'll reduce consol RE. Now tell me who has the inventory? Associate. Are we recording the inventory of associate in the console SOFP? No, my dear friends. No. Then what shall we reduce? We'll reduce investment in associate, because investment in associate reflects the net assets of associate. So we should reduce net investment in associate. By what amount? URP that we compute multiplied by the associate holding percentage. Okay. Now, if associate sells the goods to parent, then what will happen? Now we have to reduce the share of profit of associate. which ideally gets accounted for in console RE. If it's a question of console SOFP, it gets adjusted from console RE only. Okay, account debit to invest inventories. Why? Because now this time parent has the inventory. Are we recording the inventory held by parent? Yes, we are recording. So we are reducing here inventory. We are reducing it by inventory. We are reducing it by inventory. We are reducing it by inventory. Okay, by what amount? URP multiplied by the associate holding percentage. I believe it is very much clear. Guys, please make sure that you are doing this treatment. Okay, chalo. Dividend paid by associate. What is the treatment of the dividend paid by associate? So now understand, when the associate would have paid dividend, parent company would have recognized the same as dividend income. Okay, so now if the question is of a console SOFP, reduce consolidated RE by parents share of dividend plus reduce investment in associate. But if the question is of console P and L, reduce share of profit, reduce investment income of parent in group P&L. This is what is the treatment. That's all. By parents share of dividend. By parents share of dividend. Why? Because parent would have recognized it as income. Parent would have recognized it as income in the individual FS of parent, which ideally is incorrect in the group FS, right? Hence we have to remove that impact. And hence we are reducing it from the investment income of parent if it's a question of console P&L. If it's a question of console SOFP, we reduce from console RE, we reduce from investment in associate. Clear everyone? Now comes a question of lease remeasurement. Now understand. Here we complete all the discussions from the point of view of FR. See, understand, we discussed these. Now FR students, I am discussing one more part. After that, I request all the FR students, you can leave this session. Okay, you can leave this session, but leave after liking the session. Okay, I'm discussing first of all change in the format of P&L. I'll discuss that, then you can leave. Not now. First of all, let me discuss the change in the P&L format. And then you can leave. Okay, let me discuss it off. First of all, change in the P&L format. Just allow me a moment, please. IFRS 18. Change in the P&L format. So now understand. Previously, the format of the P&L used to be revenue minus cost of sales, gross profit minus distribution cost minus admin X costs. Is operating profit minus finance cost plus finance income PBT minus tax expense is PAT. Now the P&L is divided into, now as per IFRS 18, the P&L is divided into 5 parts: operating, investing, financing, income taxes, then profit from discontinued operations. Understand? Revenue, cost of sales, gross profit, selling expense, general admin expense. This is the operating part of the P&L. Now, then income from investments. This is the investing part of the P&L. Then profit before financing and taxes. Now, finance cost. This is the financing part of the P&L. Minus taxes. This is the tax part of the P&L. Now, profit or loss from discontinued operations is added as per IFRS 5. This is the last part of the P&L, and then comes profit for the year. So what I'll do is I'll paste the revised format. I'll paste the revised format in your notes so that you can refer it off. Okay, I'll paste it here itself. I'll paste it in the very first page itself. Now, ACCA in your SBR, they have also given you one format. I'll paste that format also with you guys. I have pasted that also. The operating part, the investing part, the financing part, everything is here. Everything is here. Okay. IFRS 18. I have pasted, I have explained the change in the P&L format. Now, FR students, you can leave. I have discussed the common topics of FR and SBR. From now onwards, I will be discussing SBR pertaining topics. Okay, the topics which are specifically required for SBR. But yes, guys, I hope this session helped all of you. And please make sure that you are giving a feedback in the comment box. Okay, once the session is over, you are giving a feedback in the comment box. Okay. Now I am starting the only SBR pertaining topics now. If you want to watch the session, definitely you can. There is no such challenge in that. Please remeasurement. Just just give me 2 minutes. I'll be back. Just give me 2 minutes. I'll be back. Okay. See, we are almost done. We have to discuss 5 to 6 topics more. 5 to 6 topics. We'll wrap up this session in within 30 to 40 minutes. Have patience. Be with me till the end of the session, and definitely this will definitely help you. Okay. But just give me 2 minutes, then I'll resume back. Sorry, guys. I had to fill my water bottle. It became empty. Okay, chalo. Let's resume back. Can you hear me? All of you, come on. Can you hear me? Okay. Now, topic number 20 is the lease remeasurement. Is from lease remeasurement. Now, what is the meaning of lease remeasurement? Understand, guys. Lease remeasurement is the change of the estimates. Understand? Nothing changes in the contract. Nothing changes in the contract. Just that the estimates of the lessee changes. Estimates of the lessee changes. Now, what are the estimates made by the lessee? What are the estimates made by the lessee? Estimates can be the estimate of guaranteed residual value, the index, the consumer price index, or the reasonable certainty of exercising any options, or the reasonable certainty of exercising any options. Now, the standard says that whenever there is a change of the estimates, the accounting has to be done prospectively. The accounting has to be done prospectively as per following the principles of IAS 8. Following the principles of IAS 8. So now what we do here is we say, what is the calculus? What is the carrying amount of lease liability? What is the carrying amount of lease liability? Now, what is the revised lease liability as per the, what is the revised lease liability as per the revised lease payments and the applicable discount rate? Why am I saying applicable discount rate? Understand, if the change is the change of GRV or index, revised lease liability will be computed using original discount rate. If the change is the change of reasonable certainty of exercising any option, we will use a revised discount rate. But if both changes, let me just do it off. If both changes, then we will take a revised discount rate. Then we'll take revised discount rate. Okay. Now, how to do the lease remeasurement? So on the date of lease remeasurement, we will compute what is the carrying amount of lease liability. We will compute what is the revised lease liability using revised lease payments and the applicable discount rate. It can be original rate, it can be revised rate, it can be revised rate. Now, once you're calculating the carrying amount of lease liability or the revised lease liability, compute what is the change in lease liability and make a corresponding change to ROU. Let's suppose if the lease liability has increased by 10 million, increase ROU also by 10 million. Entry will be ROU account debit to lease liability 10 million. Now, to explain this concept, I have taken up an example. Okay. I will strongly recommend all of you to solve this example. Okay. Now understand how. So what is happening here is, understand, I will be explaining this question in brief, not in detail definitely, but just understand what is happening here. What is changing? First of all, let me know what is changing. Kingfisher enters into a 4-year lease of property with annual lease payments of 1 million payable at the beginning of each year. According to the contract, lease payments will increase every year based on the consumer price index in preceding 12 months. Consumer price index commencement date is 125. Okay, now at the beginning of the second year, consumer price index is 140, means consumer price index is changing. So tell me, which discount rate shall we use? Original, revised? Original or revised? Since CPI is changing, the index is changing, we'll use original discount rate to compute the lease liability, the revised lease liability. So now first of all, it is happening at the beginning of the second year. So now we will first of all need to find at the beginning of the second year what is the carrying amount of lease liability. Now we need to find out what is the revised lease liability considering the present value of the revised lease payments at original discount rate. Okay, now which happens to be how much? 3.20, which happens to be 3.20. Now I will compute what is the change in lease liability. 3.20 minus 2.86, that is 0.34. Your lease liability is increasing by 0.34. So you will increase your ROU also by 0.34, and the journal entry will be ROU asset account debit to lease liability 0.34. I believe it is clear. Guys, whatever examples or questions that I am taking up in this session, I strongly recommend all of you to solve it immediately after the class. Okay, these notes will be shared in my Telegram group. The link of it is already pinned in the session. Also, you can find that the link of my Telegram group in the description box of this video. Now, coming to NCA HFS, non-current assets held for sale as per IFRS 5. Non-current assets held for sale as per IFRS 5. Now understand. So what we have to do on the date when the asset is classified as held for sale, what you have to do is you have to compare the carrying amount with the fair value less cost to sell. You record the asset at the lower of the two. Now the loss that comes up, understand guys, this is a very important concept where you make a mistake. When the loss that comes up, first of all, adjust it from the revaluation reserve if you have any balance. Any excess loss is adjusted from the P and L. Now, this happens on the date of classification. This happens on the date of classification. Subsequently, what happens? We do not depreciate the asset as per IAS 1638 or 40. We do not do the revaluation of the asset as per IAS 1638 or 40. We do not impair the asset as per IAS 36. Subsequently, we record the asset at lower of carrying amount or fair value less cost to sell. And if any loss that comes up, now any loss that comes up will be recognized in P and L only. Why? Understand, when you classify the asset as held for sale, it is termed as derecognition of the asset. And what IAS 16 says, whenever you derecognize the asset, any balance in the revaluation reserve of that asset transferred to retained earnings. Now tell me, on this date, do you think will there be any balance in the revaluation reserve? No, because all the balance on this date of revaluation reserve after this adjustment is transferred to retained earnings. Is that clear? So this is an area where you can make a mistake, or this is an area where you can make a mistake. So understand, on the date of classification, any impairment loss of IFRS 5, first of all from revaluation reserve, then to P&L, subsequently only P&L. Please don't make a mistake here in the exam. Now, ceiling adjustment. Now understand, this is a concept from IAS 19 on employee benefits. Now understand, ceiling adjustment generally comes in the question of net asset position. So understand guys, if it is a defined benefit plan, funded plan means what? Plan assets will exist. Now, there will be two things: present value of the defined benefit obligation and the plan assets. Present value of the defined benefit obligation and the plan assets. Now understand, when there are these two things, there can be a situation of net obligation or a net asset. If there is a net obligation, we record the net asset. If there is a net obligation, we record net obligation as a liability in the SOFP. But if there is a net asset position, in that case comes the concept of ceiling adjustment. Because understand, it has always been the case that whenever it is an asset, we test that asset for recovery. Right? We test that asset for recovery, whether we will recover the whole amount of the asset or not. If it is not recoverable, we impair it. So you can understand, this is an impairment of the plan asset. This is an impairment of the net asset. Okay, ceiling adjustment is nothing but the impairment of the net asset. Impairment doesn't happen of the liability. That's why in net liability position, we don't test it for ceiling adjustment. Now we had this question. So now understand, let us discuss this question. Okay, let me quickly try to solve this question for you guys, so that you understand this question in a very simple and yet crisp manner. Plan assets, PVDBO, ceiling, net. Copy, paste. I'll be solving in a fast manner, guys. Colombia has for many years operated a defined pension scheme. On 1st January, the opening assets was 260. Opening. Liability is 200. So it's a net asset position. 60 is a net asset, but ceiling was 20, means ceiling adjustment that we have done is 40 and the net asset comes to be 20. Okay. Now further, discount rate is 5%. So interest rate. So interest is 5%. So 5% of 260 is 13. 5% of 200 is 10. So it is 300. 13 minus 10 is 3. Okay. Not here. Okay. So here it will be how much? Okay. Then this is interest. Okay. So understand, net is opening minus understand, net is plan asset minus PVDBO minus ceiling adjustment is your plan. Okay, is your plan. Now so it will be now net, then further current service cost there it will be 40 multiplied by 0.05 is 2. Current service cost is 30. Current service cost, what is journal entry? Current service cost account debit to PVDBO. So 30 here. Cash contribution. What is the journal entry for cash contribution? Plan assets account debit to bank. So it will increase contribution. It will increase your plan assets. Okay. Now is benefits paid 25. What is the journal entry for benefits paid? PVDBO account debit to plan assets. Benefits paid is 25. Scheme curtailment and settlement. Curtailment means reduction of the PVDBO. Settlement means reduction of the plan assets. 28 and 16. Now, so with this, your carrying amount comes up to how much? Your carrying amount comes up to how much? 260 minus 13. Sorry, 260 plus 13 plus 21 minus 25 minus 16 is 253. Now PVDBO is how much? 200 plus 10 plus 30 minus 25 minus 28 is 187. This is the carrying amount. What is the fair value? What is the fair value? Just see towards the end. The fair value of the pension scheme assets were 242 and liability 195. 242 and 195. So what is the remeasurement gain or a loss? 253 minus 242 is 11. This, where will this 11 go? Other comprehensive income. 187 minus 195 is 8. Where will this 8 be recognized? Other comprehensive income. Okay, so understand, your plan asset is decreasing, it's a remeasurement loss. Your PVDBO is increasing, is your remeasurement loss. So this is your remeasurement ka loss. Loss which will be recognized in other comprehensive income. Now, further. So now tell me, after all this, what is the fair value of net asset? What is the fair value of net asset? 242 minus 195. 242 minus 195. That is 47. Now tell me, what is the fair value of refunds or reduction? What is the fair value of refund? Is 25. It is 25. So now what is the ceiling adjustment that you have to do? What is the ceiling adjustment that you have to do? 47 minus 25 is 22. And where will we record this? Other comprehensive income. Clear everyone? Clear everyone? Chalo. Now moving on to topic number 23, that is contingent consideration. Guys, I understand you already know the concept of contingent consideration. That is, on date of acquisition, we recognize at its fair value, and subsequently whatever fair value changes are there, it goes to P and L. But now recently I saw a question where there was something else also asked, and I want to discuss this part. So now what happens? It's if there is a contingent consideration that is to be settled in the form of equity shares of the parent company. Ideally, contingent consideration is to be settled in the form of cash, but the payment is not certain whether we will pay or not. It is not certain. Why? Because there is a condition attached to it. Okay, everything remains the same, but the settlement has to be done in the form of equity shares of parent rather than the cash. So in that case, what happens? We have to see whether the number of shares are fixed or variable. If the number of shares are variable, then the treatment again is same, because if the number of shares are variable, it is a financial liability which has to be recognized at fair value on the date of acquisition. Subsequently, any fair value changes will be recognized in consol P&L. But if the number of shares are fixed, this is my concern which I want to discuss. If the number of shares are fixed, it becomes equity as per IFRS 9. As per IAS 32 and IFRS 9, this becomes equity. And if it is equity, we record at its fair value on date of acquisition, but subsequently we do not remeasure it because equity is not remeasured. So subsequently we do not remeasure it off. I believe it is very much clear to all of you. Okay, now coming on to topic number 24. Now what happens here is, it's a case of step acquisition. Now what I want to discuss here is, guys, and understand, let's suppose here I have acquired 40%. Here I have acquired 20%. So tell me, what is the date of acquisition? This is your date of acquisition, the date when you acquired the control. So now on the date when you acquired the control, standard says that you have to remeasure the previously acquired interest at the fair value on this date, and then compute goodwill. See here, I have taken up a question. So now while computing goodwill, see, this was the cost at which we acquired 40%. The fair value as on this date is 105,000. So while calculating goodwill, I will take 105 and I'll not take 90. Right? So this is what I wanted to discuss here. The difference goes to P&L. So what is the journal entry in the consol FS? The journal entry is investments account debit to consol RE. Now, topic number 25 is a foreign subsidiary topic. It is a topic from foreign subsidiary. It is a topic, guys, understand, though I have explained this question in brief, but I will strongly recommend all of you to solve this question right after the class. Will you do that? Come on, guys, please tell me. Will you do that? I need answer from each one of you. Come on, guys, tell me. Will you do that? Okay, now treatment of foreign subsidiary. Understand. Here, I don't want to discuss the entire question, but for your sake of understanding, I have solved the entire question on foreign subsidiary and given it to you in your notes. But I just want to discuss this part because the part where student makes mistake, the treatment of exchange gain or loss. The treatment of exchange gain or loss is my concern area. Understand. When you solve a question on foreign subsidiary, you will get two exchange gain loss, one on the net assets, one on the goodwill. Whatever exchange gain or loss is for that period goes to other comprehensive income. In SOFP, we accumulate where? So on the net assets, whatever exchange gain loss we get, we accumulate parent share in FCTR, NCI share in NCI. Okay. Now the next is goodwill. Whatever exchange gain or loss goodwill comes for that year goes to OCI. But in SOFP, where will we accumulate? Now the standard says that if NCI is at fair value method, parent share to FCTR, NCI share in NCI. But if NCI is at proportionate share method, we accumulate only parent share in FCTR and nothing else. Now, with the help of this question, I just want you to see it of how it works. But I will strongly recommend again to all of you, please do solve this question. Okay, there is no such full-fledged question in your book, but questions have come up in the exam. And there you might struggle. So struggle now itself and try to solve it off. Let me show it to you. Now just see here. In the question, just read. NCI is at fair value method. Now let's see the treatment of exchange gain or loss. Understand. The exchange gain on net assets is 28.97. It is on net assets. So irrespective of NCI is at proportionate share or NCI is at fair value, irrespective of that, These exchange gain or loss will be recognized in parent and NCI in the ratio of their shareholding. See, NCI share 28.97 and parents share 28.97 का 90%. Okay. Now, goodwill. The exchange gain on goodwill that comes is 19.24. Since NCI is at fair value method, we'll allocate to NCI and console RE both. See here, goodwill impairment NCI, goodwill impairment net console RE. We are writing in both. Now console RE means what? It will be accumulated in FCTR, not console RE, not console RE. It will be accumulated in FCTR. Sir, what is FCTR? Foreign currency translation reserve. Sir, where is it recognized in SOFP? It is a part of other components of equity. In equity, there are three things. One is equity share capital, another is retained earnings, another is other components of equity. So FCTR forms part of other components of equity. Okay. Nadeem is asking, where can we find these notes? Nadeem, you can find these notes. You can find these notes in the Telegram group. The link of the Telegram group is already pinned as part of this chat box, or you can find the link of the Telegram group in the description box of this video. Okay. Chalo. Topic number 26 and the last topic for the day, console cash flow. Console cash flow. Now, I have seen students struggling in this concept. Guys, understand. Let's suppose we have acquired subsidiary during the year. We have acquired subsidiary during the year. So now understand, when we talk about console property, plant, equipment, in the opening balance, it is parent plus one subsidiary. We have acquired S2 during the year. So closing balance will be parent plus subsidiary 1 plus subsidiary 2, because subsidiary 2 is acquired in the current year. Now tell me, when we prepare PPE account, we say to balance B by D, by balance C by D. To PPE of H2. Tell me, is it a cash flow item? Is it a cash flow item? Have we paid cash to acquire property, plant, equipment of subsidiary 2? No, it is not a cash flow item. It is not a cash flow item. It is not a cash flow item. So while calculating the amount paid in cash to acquire property, plant and equipment, reduce this PPE. Okay, not only PPE, it is applicable for all the assets, all the liabilities. Whenever you are taking the movement, adjust the net assets of the subsidiary acquired. Adjust the net assets of the subsidiary acquired. In December 2023, Kabilo company, there is a question in your ACCA practice platform. I will strongly recommend all of you to solve that question, because console cash flow is the favorite topic, is becoming a favorite topic of the examiner these days. So I will strongly recommend you guys to please go and solve December 2023 Kabilo company, which is a classic question, the classic question on console cash flow. Okay. Now, rather, in console cash flow, what we adjust is cash paid to acquire subsidiary. Now, how do we calculate cash paid to acquire subsidiary? It is actual cash paid minus cash balance in the subsidiary that we acquired. Okay, what is the balance of cash in the subsidiary that we acquire? We reduce that. This is the net cash paid to acquire subsidiary, and this is a cash outflow. This is a cash outflow which is recognized in investing activity. Okay. Topic 26 also discussed. Change in P&L format, already I have discussed. So this completes my discussion. Now, Swayam, I believe you asked me a concept of loss of significant influence, right? So in that case, there is nothing major that we have to do. There is nothing major. Whenever there is a loss of significant influence, we recognize the investment in associates, the carrying amount at equity method, we de-recognize. We recognize the remaining investments at its fair value on the date of disposal. The difference goes to console. The difference goes to P&L. Okay. The difference goes to P&L. Is it clear, Swam? Again, I'm repeating. We de-recognize the investments at equity method. We recognize the remaining investments at fair value on the date of disposal. We recognize the sale proceeds. The difference goes to P&L. Okay, let me write that. Loss of significant influence. Topic number 28. Loss of significant influence. In Group FS, we de-recognize investments in associate. We de-recognize investment in associate at equity value, equity method value. We recognize investment retained debit at fair value. We recognize sale proceeds, bank account debit, sale proceeds, and the difference goes to P and L. The difference goes to P and L. Is it clear, everyone? Clear, everyone? Subsequently, we will measure these investments at its fair value. The gain or loss will be recognized in P&L or other comprehensive income as per the method of valuation selected by the parent company in its individual financial statements. And it will be no more be a part of the group. I believe it helps you, Swam. Okay. Now, that's all for the today's discussion. I believe this session would have helped you. Okay. That's all for today. Wrapping up the session. And yes, all the best for your exams. Tomorrow I'll come up with a video on how to prepare for the till exams. What should be the strategy? I'll be coming up with a video tomorrow. Do watch that. Okay. Also, don't forget to like the video, subscribe the channel, and give your important feedback in the comment box. Please give your feedback in the comment box. That's all for today, guys. Thank you. Bye bye.